Professional options traders have a preference to sell options premiums over buying. So in today's video, I'm going to explore how you can potentially harness volatility using a popular options income strategy with limited risk. This preference to selling options by traders is due to what's called the volatility risk premium. In a perfectly efficient market, options sellers would net a zero net gain over a lifetime of selling, as the premiums collected would theoretically offset any losses from the volatility of the underlying asset, which is the risk that you're taking as an options seller. However, when we review the data, we find that options premiums consistently overstate the actual volatility of the underlying asset. What this means is that as an options seller, you have the advantage. The premium that you collect offsets more than the actual risk of the trade over the long run. And this has been well documented by empirical evidence over the past few decades, and it remains true across multiple asset classes. However, similar to an insurance company, options selling requires spreading out the risk over a large number of trades, with each potential loss to only account for a small percentage of your total portfolio. However, not everyone has the luxury of a sizable portfolio, which brings us to the Iron Condor option strategy. An Iron Condor is a directionally neutral strategy that allows you to potentially collect options premiums with limited risk. And just like all complex option strategies, they can be better understood if we break them down into their foundational parts. You can think of an Iron Condor as either selling an out-of-the-money strangle while buying back a further out-of-the-money strangle to offset the risk of the short strangle. Or you can think of it as selling both a bull put spread and a bear call spread at the exact same time. The profitability of this strategy lies in the volatility environment. So today, I'm going to show you how big of an impact implied volatility has on this strategy. We're going to use VolQ, the NASDAQ 100 Volatility Index, to compare two distinct times and just how much premium an Iron Condor structure would have provided. We can see that on August 25th of 2021, VolQ closed below 15%, one of the lowest readings of the index. And we're going to contrast this with June 13th, 2022, where there was more than double that at over 38%. And you should note that these are not the most extreme readings of the NASDAQ 100 Volatility Index since the start of the pandemic, but they're simply near them. On August 25th, 2021, the NASDAQ 100 Index closed above $15,300, and a 30-day 25 Delta Iron Condor, where we're selling the 25 Delta call and a 25 Delta put with a $100 wingspan, buying the strike prices that are $100 outside of the short strikes, would have created a 14,725, 14,825, 15,750, and 15,850 Iron Condor. That translates to a potential profit of $4,100 with a risk of $5,900. And this is an Iron Condor that if NDX stays between the inner strikes of 14,825 and 15,750, however, note that these strikes provide an investor with just 3.7% of downside and 2.7% of upside before this Iron Condor starts to show losses at expiration. If we contrast this with a 30-day 25 Delta Iron Condor that has a $100 whiff on June 13th of 2022, the high volatility day when the NASDAQ 100 closed at 11,288, the strikes for that Iron Condor would have been the 10,400, 10,500, 12,175, and 12,275. This Iron Condor would have collected $46.70 of credit, which translates to a potential profit of $4,670 and a risk of $5,330. A better risk to reward ratio than the previous trade, But more importantly, this Iron Condor gives the investor 7.3% of downside and 8.2% of upside before the Iron Condor starts to show losses at expiration, more than double the previous Iron Condor. I hope that this provides context as to how the volatility environment significantly changes both the premiums and the risk to reward of an Iron Condor depending on how the volatility of the underlying instrument or index is. Using a volatility index such as VolQ can provide insights into the timing of such a strategy. Additionally, because Iron Condors are directionally neutral, at least initially when the trade is established, they are best initiated after a large outsized move. Against conventional wisdom, our statistics show that markets have a better statistical chance of consolidating or trading sideways only after a large move. Lastly, one tip for maximizing an Iron Condor trade is that you actually have the ability to collect more premium after entering the trade if the market starts to test one side of it without adding any additional risk. If, for example, the underlying starts to drift higher and starts to test the upper strikes of the Iron Condor, you can adjust the side of the lower strikes, the bull-put spread, to a higher strike price, as long as the new strikes are equal or smaller in terms of the vertical width. You'll be able to collect more premium without adding any additional risk. Vice versa, if the market trades lower, you can adjust the higher strikes of the Iron Condor, the bear call spread side, lower and do the same thing. I really hope that this video helps you better understand Iron Condors, because it may seem like a complex strategy, but by breaking them down into simpler components of two credit spreads, they become easier to understand how to maximize yields and manage them separately as parts of one trade. And lastly, I hope the contrast of higher and lower volatility environments of this trade during different volatility environments can affect the income that you receive. And I'd just like to say a huge thank you for watching this video, and please hit the subscribe button and let me know your experience of trading Iron Condors in the comments below. And with that, I hope that you have a great trading day.